All right, well, welcome to our session on Gen AI and finance scholarship. For our panel today, we have Harvard's Xavier Gabaix, Wharton's Itay Goldstein, and Chicago's Dacheng. I'm going to start with a little disclaimer, which is that while we will certainly discuss Gen AI in this session, we are not restricting ourselves to that. So Gen AI has certainly captured the imagination of the public. It's gone a long way towards confusing the language that we use when we talk about it, and that's something we can discuss a little more if people are interested. But they're just one of many tools that are used in conjunction with each other, and we're not going to be as restrictive as limiting ourselves to just talking about Gen AI. The session today, by its nature, is also hopefully speculative, more speculative than a lot of what we do in academics. And I hope that when we get to the panel, that really it won't just be us, but that we'll have broad participation, especially with that speculative nature. None of us really know what's happening. So before we get to the interactive panel, I've asked each of our panelists to talk a little bit about their own work, which has informed the way they think about the topics that we're going to get to when we get to the discussion. And in particular, I've asked them to talk about their own work in a way that, to the extent they can, that they do it at a high level, that they emphasize intuition, and again, that they speculate both on the potentials and the potential limitations in a way that we might be more speculative than we would do in a typical academic talk. All right, so more than anything, I hope we can have some fun. The topic, I think, leads to lively discussion. And I hope everyone will participate. Okay, so we'll start off with Xavier.
Great. Good afternoon. So this is those thoughts are very speculative, like Robert said. They're inspired by conversations with my co-authors, in particular Ralph, Moto, and Rob. And I'll draw some results from two papers: asset and investor embeddings, and upgrading credit pricing and risk assessment through embeddings again. Okay, so I'll start with some general observation to see the landscape outside our little world, okay? And that will be some observation useful for the general discussion, I think. Okay, so in AI, competitions have been extremely useful to accelerate basically research. And for instance, most of you know that, but let me just mention it nonetheless, just in case. For image recognitions, you had this ImageNet competition. So the task, you have lots of images, you need to classify cat, dog, cars, etc., etc. Participants submit programs, new images are given, and then you see who is more successful at classifying the pictures. And you could see some evolution, and one year, there was AlexNet. It was the first successful deep network that increased a lot the performance of that competition. For protein folding in biology, so as you get a protein written with C, H, O, various whatever atoms, and you need to predict the three-dimensional structure. So there's also an annual competition, and there was a breakthrough AlphaFold from Dickman. That was a very big deal, and they got actually a Nobel Prize for that. So one inference one can make from that is it would be great to have many more competitions. We have essentially none in finance and economics, organized every quarter, every year, to where people can submit the program. We can see how well they do, and more thoughts will come soon about how to do that. Now, another observation is that those predicting is very useful, but sadly, in some sense, or interestingly, you don't need a deep understanding for that. So LLMs, large language models, they've been immensely useful for text translation, generation, etc., but they use exactly zero Chomskyan linguistics, for instance. Very interesting. AlphaFold, protein folding, it uses zero Schrödinger's equation, zero like very, very fundamental high-level physics. Maybe it does use existence of atoms, existence of molecules. It doesn't simulate what happens, and it does use learned geometry from existing structures and something about evolutionary data, but very little in terms of high theory, if you want. So likewise, you could imagine a process by which we'll be able to predict better and better, not just what the market does, but maybe what investors do, and a variety of things, maybe in macro, using various AI machine learning techniques. And that will be great, but it's probably the case that at least for a long time, theory will not be that useful actually for that. Still, what's nice in terms of the understanding dimension is that once we have those prediction engines trained via AI techniques and knowledge diffusing via competition, they will be useful to constrain theories, because your theory, instead of testing it on a very, very simple, maybe ad hoc data set, you will see how it explains reality as it's been encapsulated by the prediction engines. Anyway, so that's like a view on how we might proceed. What kind of papers will AI engines write? So I find it useful to call on the Kakutani matrix. So I teach that to my students. The law is that Kakutani was teaching that, and it propagates. So according to him, there are four types of papers. So a paper can be easy or hard, simple and complicated. So what's that? Simple and easy, that's like an exercise, okay? Hard and complicated, it's almost impossible to do. It's like, the proof of Fermat's theorem or something. So most papers, and certainly many papers that AIs will write it initially, are in the easy and complicated box, which is a useful box, okay? So you have some macro model there, some asset pricing model, then you glue them, and there's something interesting going on. It requires skills. Those skills presumably will be deprecated by AIs. But you don't need to reinvent many wheels. You just put together various things that are there, and tell them, students, try to aim at the, how do I go back here? Simple and hard. And I think that AIs it will take much more time for them to do the hard things, meaning some, really inventivity, etc., but they will be very useful to do the complicated assembling of things. That will be a great plus for financial economics, because we'll be able to this way maybe predict better, have more macro model useful for the Fed and the BIS, etc. And it will be useful for world welfare and our credibility. We can predict and mimic the world better, helped by those AIs. So let me, in part to talk about these competitions, I have in mind, draw from a paper we have, a course called Asset and Investor Embeddings. So just, many of you in this room know what it is, but let me just say what's an embedding. It's just a vector. So in some typically high-dimensional space, maybe 100-dimensional, 1,000-dimensional. So if you have XA for A being some asset, maybe Apple, it will be a vector of characteristics traditionally that you know from like accounting data, or maybe something we will infer from some other source, as I'll explain. And in the NLM, that's like some of the key components of one of the key components of LLMs, and you have nice properties that make sense. If you take the X Paris, that would be the vector, maybe in a 1,000-dimensional space representing Paris, minus the vector for France, plus the vector for Spain. And periodically, it's kind of close to the vector for Madrid. So it kind of makes sense. It captures what seems to be going on in some way. Okay? And there are a number of papers using embeddings, but I think there will be many more. So just a few slides from what we do here in our paper. We say, so we have, we model demand by investors in a semi-behavioral model, and the log value of how much investor I invest in asset A, think in dollar terms, we'll call it lambda I prime times XA plus some constant and some noise. So lambda I and XA, those are vectors, those are the embeddings. Okay, in the simplest model, we have fancier model later that I won't talk about. Lambda IK is the taste of investor I for characteristic K. and XA is like the loading of asset A on characteristic K, how much it loads in maybe doing AI, for instance. And you can imagine some investors want to do a bet on AI, so they bet on this they have a high taste for characteristics K that would be AI. And we can learn the proposition, a very simple proposition, or in principle, with enough investors and assets, we can, generically, we can learn all the relevant characteristics from just this holdings data by doing basically some sort of PCA or something fancier. And with that, say for instance, with this investor embeddings, in principle, you have lots of things you can do, and we have just scratched the surface. You can classify investors by beyond institutional type, etc., by seeing what is it that they like. And you can look at maybe identify crowded trades, do much more precise performance measurement, etc., etc. So it's failed to start my timer. So you tell me how much time I have. Okay. So, how do you extract embeddings? The simplest is to do PCAs called representative system, and you can do transformer models, but there's no time for us to do it now. You get interesting results. So I'll show you how you do the plain thing. It's very simple. You say, I want the model to fit optimally, so I minimize the sum of squares, and also I have a rich penalty to have a not too complicated model. Okay? And another type of loss function, and thinking about loss function is very, very fundamental for AI-friendly research. It's mask modeling. So guess the word. So in linguistics, you must have seen that. A lot of how you train an LLM is you predict the word. For instance, please pass me the and pepper. What is the and the LLM will be trying to make the right guess probabilistically. So part of what we do is we train the LLM on our own little transformer machine. Here's a hedge fund, for instance, ARK. We show you all the holdings of ARK, masking by size, ordered by size, except we mask here the fourth one, and the machine needs to predict the number 4. So that forces the machine to learn in some sense some of the structure. Again, we just imitate what they do in machine learning using some financial data. So we use FactSet type of data and other kind of Jensen et al. Characteristics and pharma-French characteristics. We compare that to traditional, very plain pharma-French characteristics, book to market, market cap, beta, etc., etc. And we compare that. We compare our holdings-based embeddings to them, and also what if you just did the word embedding from AI for say IBM? What would you get? Okay, so now the key thing is, suppose we wanted to do a competition between not just our model, but lots of models. What would be meaningful benchmarks? So we thought about 3 benchmarks. You can think of more. One is prediction relative valuations in a given quarter. So you say, you regress the log market value, MA, on the book value first, the simplest predictor, and you get a residual, MA perpendicular. Then you try to explain what's not explained by book value via the embeddings. So you got your embeddings drawn from holdings, okay? And you try to see how well do they explain valuation. You feed that on 80% of a sample in a given quarter, and then you calculate the R-square for the rest of a sample, the rest remaining, say, 20% of a sample. What's really important here, you don't need any time series data. With just one fresh quarter of data, you can see which model is best. This way, each quarter you'll have a new round of competition, and that's very, useful. Wait, another one would be explaining co-movement. So you calculate the co-movement. How much do those embeddings explain the co-movement in a given quarter, maybe using daily data or something like that. Okay, and you can feed the R-square. Another one would be this asset similarity in managed portfolios, like guess holdings number 4, number 8, number 16, that kind of thing. And again, something I want to emphasize is those benchmarks, very useful to discriminate. You just need one quarter of data to do the competition, as opposed to a more traditional, like fit the pharma French portfolios. You know, we had already tons of profession-wide data mining on those portfolios. And if you have one more quarter of data, it's almost the same data set. So it's very hard to really have, new, out of sample way to discriminate between models. So here's something we find with our, first pass. CAPM beta, terrible, confirmed. It explains about 2% of the R square. Okay, so again, the pharma French characteristic explain maybe 15%. Okay, just the largest, fairly high dimensional embeddings that we've used from holdings data, they explain about 60% of the R square. So we say, wow, there's a lot of information in the embeddings. Okay. You can combine characteristic embeddings, you do a little more and reach something close to 70%. Okay? So embeddings are very, very useful, more useful than traditional, at least pharma French characteristics. Text embeddings from OpenAI, etc., would do miserably, because they say IBM, they don't really know what it means, whereas using investor revealed preferences, there's much more semantic richness there. Let me skip that. Explaining co-movement, actually, then pharma French characteristics do pretty well to explain co-movement. It's not very big, it's 5% R square. And embeddings do, maybe it's there was a profession-wise data mining, I don't know, or just growing wisdom. That's another possibility. Our embeddings per se do less well, but they add still some value to the characteristics. Pharma French characteristics. And asset similarity is guessing some mask assets. We do, there's something, young transformer-ish model like work-to-vec does actually pretty well, much better than everything else. So we get to see how those benchmarks can be used and how embeddings can be useful. Let me skip that. And you can also get insights about, what are investors similar in the endemic space to DFA, lots of funds I never heard of, or similar to AQR, etc. So it helps you, navigate the space better and maybe understand better. We also do the same, this was all for stocks, we also do the same for bonds in a fixed income paper with the same team. And then one of the insights is that potentially AI could automatize the production of bond rating. So I won't explain how, but potentially you could. And that could be a very, very useful engineering way of using AI in finance. Okay, I'd like to say a little more about the advantages of competition in finance. So again, in asset management, we try to discipline ourselves to use really just 1/4 of data will be very, very useful for new competition. And in general, in the profession, I invite you, it's great to think about more benchmarks and maybe volunteers to organize such competitions. Again, they've been crucial in biology, in computer science to get the ball rolling. Why are they useful? So it's a useful way to measure and stimulate progress, and also it's more democratic if you want. So suppose you had a bright and obscure student from Indonesia, could have a fantastic way to do things and completely win the competition. Where if it's, publishing in the Journal of Finance, let's say, there are so many barriers to entry in the various mannerisms, the profession, and what you should cite and not cite, etc. It's completely, it creates lots of artificial barriers to entry, whereas, or maybe voluntary, but anyway, it would remove some of the barriers to entry. So that's very good. And there's an interesting paper by Hellum, Jensen, Kelly, Pedersen, that also proposes competition, recent paper, but they use more time series kind of thing, and maybe we can convince them to use cross-sectional things. Okay, and what's the advantage of having those clear metrics of success? You can, one, you can see what techniques seem to work. Another, you can automatize the production of new algorithms and potentially new theories. So in the AI, it's called reinforcement learning, as you've heard, but reinforcement learning with verifiable rewards. So for instance, you try to train the AI to solve math problems. At the end, you can test that is the proof correct or not correct. So it's a verify reward 0 or 1. So likewise, you would have those verify rewards. And so that immediately allows you to, in principle, to build more and more good prediction engines that will encapsulate a lot of regularities in the world. But also, once you have them, you can, so second round almost, iterate on parsimonious theories. They will never do as well as the black boxy prediction engine, but maybe you can test them more immediately on the whole of reality as captured by this prediction engine. Anyway, that's how I can see how AI could be useful to do even theory. Please to do more, I think we need more engineering applications and successes in economics and in finance. We had some fantastic successes like portfolio formation, Markowitz, Black-Scholes, amazing. Finding alpha, very useful, at least privately, maybe not socially, useful for hedge funds, definitely. Now I think we have lots of opportunities of really concrete novel things to do for MBAs, more applied, real-world applied PhDs using AI. So predicting returns, a lot of work is done in hedge funds. Some of the great ways also done in academia, often with people linked to hedge funds, like Brian and Dacheng and people like that. Predicting macro would be very useful. It's a great shame, as part of why we're not that considered and listened to, is because we don't predict very well. So if we had even the AI-based ways to predict, that would be fantastic. Like I said, we could potentially replace Moody's bond ratings using AI, some economic thinking, by the way, and embeddings, and your decision-making tools. There are lots of very, very concrete things we can do. What about pure, like, university-level research? So here I'm going to show you some slides given by my co-author, Sang-Min Ho at Columbia, which I thought was fantastic. So, so far, there are at least 3 types of AI papers: finding new data, modeling complex relationships, and fair benchmark. Let me just flag a few things. One is just generating new data via AI. It would be just too time-consuming to do it. For instance, for measuring regulation or measuring stress, looking at how people look, completely stressed and tired and aging. Another one is modeling complex relationships. So, like, clearly, machine learning is useful. Actually, Dacheng is here, we have other ways to do it. Another one is a fair benchmark. So some actually are fair benchmarks. Say, what would a rational computer do trained just with data up to 1920? What should the rational computer predict? So Blanqui and Ludvigson have a series of papers on that. I think it was very interesting. And some people like Gabaix have papers using more behavioral agents modeled by AI. So lots of good things we can do. And some of the papers, and I guess we do that too, is intellectual transfer using kind of straight ideas from AI and applying them to finance. Still, what's the role for researchers? Not just doing engineering things, but so even if you can predict a lot, we need to understand the causal mechanisms. So for that, we need to find instruments. So traditionally requires a lot of ingenuity. Like, I know the CEO died or the senator died, and this, as a result, these states lose some power, etc. Historical quirks. So AI can really help finding such historical quirks. With RAD, we have something we like a lot called granular instrumental variables. It's using idiosyncratic shocks to large firms or large hedge funds or large industries and see how they propagate in the network. And AI could be very useful also to find some, do some of the work and find some of these idiosyncratic shocks. And something else we could do is define the big goals. Part of the research talent is, cleverness. Some cleverness, a lot of technical skills, a lot of industriousness, and a knack for formulating interesting but still manageable questions. And maybe for the latter part, we have some advantage for a little while longer. So for theory, will AI be useful? Again, it's useful to look at what's going on in math. So now AI can win gold medals at the Math Olympiad, so short but extremely difficult problems. So not yet research level ideas, but it's progressing very fast. So maybe in 5 years they will be able to do it, or 10 years. So now AI research has been proven useful, say for the double descent phenomenon, which makes you want to do more very high-dimensional models in finance. For cognitive modeling, for instance, there's a very nice Barberis gene paper using reinforcement learning from AI to model people. In my own more behavioral research, I wanted to model the mind wants to build a simplified model of the world, and I thought those lasso sparsity type penalties were very useful, or people don't like complexity. It's useful to see what's going on in AI, even just to do pure theory. And there's lots of interesting work doing cognitive modeling for behavioral psychology and also economics by these kind of co-authors. Now, question, and maybe we can ask, what you think yourself is, will we human be obsolete? If AIs can do all we do, but at some point then they can do it 1,000 times faster and cheaper, won't we be completely obsolete? So that's a question. Okay, so a little bit of theory. Let's do a CS production function for those metaphysical questions. There's capital labor, you model AI, capital becomes infinitely abundant. So what's the labor share in the whole economy? So there's this thing, the elasticity of substitution rho. So if rho equals 1, it's Cobb-Douglas. If rho is less than 1, capital and labor are substitutes. So as capital becomes infinitely abundant, the labor share goes to 0. That's like the doom scenario. But if the labor share, if capital and complement are, capital and labor are complement, rho is bigger than 1, then the labor share actually goes to 100% as capital, AI makes capital infinitely abundant. So the question then is, are there enough activities for which human labor is, essential, meaning rho is bigger than 1, it's not Leontief, but, complement to capital rather than a substitute. And we can speculate, it's a bit hard, definitely maybe the human touch for teaching, maybe defining some big goals and ideas. Now AIs can do that, maybe in 5 years or 10 years they will be to do it. Or maybe we'll just be like a trusted, like a general, low-level doctors who don't operate on you. Frankly, AIs can do better than them, I think. I understand. But still people, the grandmother will trust them and they look wise and all that. So maybe we'll be like that, trusted, reassuring interfaces for the public. Or we'll be completely obsolete altogether. In part, it depends on this elasticity of substitution. So. Now, there will be a consolation, which is we came to that research life because we presumably wanted to understand the world. And before we become completely obsolete, there will be this explosion of understanding, and we'll see the world, the sky suddenly becoming lit with understanding, and that will be also our end as valuable contributors. Anyway. Conclusion, for the short run, more data types will come from AI. Competitive benchmark would be great. They're more democratic, stimulate progress. Will be hopefully lots of improvement in predictions, understanding the world at a detailed level. And we can glue together existing theories like in the easy but complicated part of the Kakutani matrix. In the medium run, perhaps we'll use AI to build new theories. Again, they will be benchmarked not just on a few moments, but on this kind of how they explain the behavior of these optimized prediction engines, built on very, very large data sets. And for the long run, maybe it will be glorious obsolescence for us humans as we pass the torch to our faster AI descendants. We'll see. Maybe we'll take a poll later to see how many years you think that may happen. Thank you.
Thank you, Xavier.
Okay. Thank you, Robert, for organizing this panel and asking me to be on it. So I'm following your instructions here to give you an overview of my work in this area. And as you noted, this is not about generative AI, but generally AI in financial markets, and in particular, using reinforcement learning in financial markets and trying to understand how AI algorithms that are based on reinforcement learning are going to change the financial market environment. So all the work that I'm going to describe here is co-authored with Winston, who is sitting here. And we have one paper that has been out for a couple of years and presented quite a lot. I will focus on this one, but I will also give you a couple of nuggets from two follow-up papers that we have that we just put out, and I think are pushing it a little further and give us some more speculative ideas on how to think about AI in financial markets. And I will keep my comments to be non-technical. So this is going to be a non-technical summary of these papers. So the big question is how AI traders are going to behave when essentially we replace humans with AI algorithms. And we all know a lot about trading and information in financial markets. We have models, we have empirical evidence. Once we think about AI algorithms that are replacing humans, things change quite a lot. The method that we are going to use in two of these papers is essentially an experimental method where we're doing an experiment on AI algorithms. So this is quite a different type of experiment than what you would do on humans, but it is also easier to implement, and I think opens the door to a lot of research that can be done along these lines. The first paper, which is our main paper, also with Yan Ji in Hong Kong, is AI-powered trading, algorithmic collusion, and price efficiency, where we basically think about how AI algorithms are learning in different ways to collude. And the idea of collusion is that they are trading non-competitively. In the second paper, we take this framework and extend it to think more generally about market stability and see whether AI algorithms have the capacity to generate bubbles and benefit from the rise and crash in prices. And then the third paper is a theoretical exercise that is trying to understand the interaction between humans and AI. So that will be the new element here, not just interaction between AI, but rather if you have a framework with AI and humans, what's going to happen? So that's maybe another take on the question that Xavier was asking, if humans are going to survive. Of course, this is more limited in the context of this model. Okay, so let me start with the first and the main paper, and I will spend most of the time on this and then give you a couple of highlights from the other follow-up papers. And as I mentioned, the way we think about it is we set reinforcement learning algorithms to trade in financial market, and we basically see how they learn to behave, what kind of equilibrium they end up with. Reinforcement learning is a basic building block in many of the AI tools that you see that are being used. What you see here is the game Go and AlphaGo, which is an example of reinforcement learning algorithm learning how to beat a human in a very complex game. The reinforcement learning algorithms that we are going to work with are going to be simpler than that, but they have the same basic principle of reinforcement learning that I will explain in a second. So how does reinforcement learning work? A very quick overview of what reinforcement learning is and how it works. So the version of reinforcement learning that we are working with is known as Q-learning. And when you think about Q-learning, imagine that the algorithm has a big matrix where on one dimension you have the state of the world, and on the other dimension you have the action. And every cell in this matrix is essentially what is the value that you expect to get if you take a given action in a given state, okay? The reinforcement learning algorithms are basically thrown into the financial market without any prior knowledge, but then they try different things and they learn over time what works best, and this is how they evolve. Of course, what is most interesting is not when you have just one reinforcement learning algorithm playing against nature, but rather a bunch of them that are interacting with each other, because then the action that each one of them takes is also affecting the state of the world for the others. So this is generally quite a complex environment that is very difficult to predict. And this is why the experiments here are so useful. So how does the Q-learning algorithm update the different cells? Well, every period, the algorithm is going to pick an action for a given state, and then they will have a new observation with which they can then update the value in this particular cell, okay? How do they update? They do some mixing between the new information they just gathered, the new experience they had, and what was the historical knowledge that they had, okay? So they basically do some kind of a weighted average between the history and what they just experienced. And then every period, the algorithm will have to choose which action to take. And the way that they do that is with some combination between exploration and exploitation, where exploration means that you're just randomly picking an action out of the set of available options. And then exploitation means that you're picking the action that currently, based on your information, is going to give you the highest value for this particular state, okay? So with this combination of exploration, exploitation, and then updating, using both historical information and the recent experience, the Q-learning algorithm is evolving and updating the matrix. And then, again, the interaction between the different algorithms is quite interesting, and trying to understand what kind of equilibrium they get to, okay? So why do we think about it in the context of financial markets? Well, AI is clearly everywhere, as we heard and will hear later in this session. And financial markets are quite a natural application. Of course, it's very hard to have hard data on which firms are using what tools. However, there are emerging anecdotes that reinforcement learning algorithms are increasingly being used, for example, in crypto markets, in FX markets, and others. The question that we address in this first paper is a question about collusion. And in the broader economic context, the concern about AI collusion has come up in different ways. For example, of course, gas stations that are setting prices based on reinforcement learning algorithms, in real estate markets. These are different types of collusion, but in general, there is always the concern that once you let algorithms choose their behavior, you will move away from competition. And we are trying to understand the extent to which this happens in a financial market. Financial markets are quite different than all these other settings. Think about the noise traders, for example, that are constantly there and injecting noise into the price. Think about the price-setting mechanism, market maker that is taking all the information and trying to set the price in a fair way. So all these things are making the financial market quite a different environment. And so it is, I think, very important to try to take these frameworks and apply them in financial markets, and then see the extent to which we are going to see this kind of collusion. Our definition of collusion is what you see there on the slide. Basically, autonomous, self-interested algorithms learn to achieve and maintain coordination without agreement, without communication, or even without intention. Okay? So that basically means that they somehow learn over time how they can coordinate on a non-competitive behavior that benefits them in the long run, even though in the short run they could have made a profit if they deviated. And we're going to talk about what are the mechanisms through which they learn to collude. I'm not going to get too much into that, but I will say that AI collusion is very important, very challenging for regulators. In general, financial market regulators are always trying to make sure that the market is competitive, and when they see signs of collusion, they are taking all sorts of enforcement actions against that. However, typically, when humans are involved, regulators are going to look for signs of actual communication among people to suggest that there is collusion. And this kind of communication does not exist with the AI algorithms. So basically, they learn how they can act less competitively without any communication, just through this reinforcement learning. And so it potentially opens the door to some broader questions about regulation and how we should think about collusion and competition in a market that is populated by AI algorithms. And I think those are questions that people should come back to in the future when thinking about new financial market regulation. Some of these concerns have been raised before by policymakers. We have here a quote from the previous SEC chair, Gary Gensler, where he says that financial market instability or even a financial crisis caused by AI is nearly unavoidable without regulation. This is maybe more related to the second paper that I'm going to mention more briefly in a few minutes. But the second part of the sentence is directly related to this paper, where he says, even if the humans aren't talking, the machines will start to have a sense of cooperation, and we've already seen this in high-frequency trading. So I'm not sure if we've seen that or not, but it's certainly a possibility. And when you experiment with that and you see how they behave in the lab, I think it gives you a great sense that this might be happening in real-world financial markets and might increase in frequency in the future. I will also say that collusion is not interesting just for the sake of collusion, but rather once there is collusion, and we see that very clearly in our model and in our experiments, once there is collusion, market quality is affected. And we basically show that with collusion, liquidity goes down, price informativeness goes down, mispricing goes up. So those are things that in general we should pay attention to. Okay, so I'm going to be brief here. As I said, this is a non-technical summary of the paper. And I will just say that we set up a trading environment that is influenced by the classic Kyle 85 model, but then extended along several dimensions. So generally speaking, there will be several informed speculators who use Q-learning to guide their trading execution decisions. There will be noise traders whose trades are not based on information. There will be sophisticated market makers that trade strategically against speculators. And there will also be a large group of information-insensitive investors. Those are known in some of the literature as preferred habitat. Those are the investors who are there in the long run, not paying attention to short-term fluctuations in value and just trade based on long-term expected value. What we basically find is that AI collusion emerges robustly through two distinct mechanisms. One of them is known as price trigger strategies. And this is basically the idea that the algorithms come to believe that if they start trading competitively, and trading competitively means trading aggressively, then the price is going to move significantly, and then once the price moves, then there will be some punishment, okay? So this is the typical notion of collusion that is generated by a potential punishment. And we call this artificial intelligence because here it seems like the algorithms are learning to behave in quite an intelligent way. In another range of parameters, we basically see that there is collusion that is driven by a very different mechanism, more akin to a bias in learning, where the algorithms just end up not trading aggressively because somehow in their memory, trading aggressively is associated with a very bad outcome, and then they just don't come back to it. And this is the learning bias or over-pruning. They kind of over-prune possible actions. And we call this artificial stupidity because basically here they end up with a collusive outcome, but not because of something particularly sophisticated. Rather, this is more of a bias. I'll show you here the main pattern that we see out of the experiments, and then I will move on to talk more briefly about the two other papers. So what you see on the left panel, in the horizontal axis, you basically see the noise of the market. So sigma U is the standard deviation of noise traders in the market. So the higher sigma U is, the more noisy the market is. What you see on the vertical axis are the profits that our speculators are making over time after the system converges. Okay? And convergence, by the way, takes quite a while, but we report results after convergence. You see two benchmarks there. The red line is what we call the non-collusive Nash equilibrium. So this is where speculators are acting competitively. And in this case, you see that they make quite a low profit. Okay? The black line is another benchmark, which we think of as the perfect cartel. This is where the speculators merge and make their decisions jointly. And obviously, when they make their decisions jointly, they are going to make high profits because then they trade much less aggressively, much less competitively, and they maximize their joint profits. And in the middle is the profit that we observe in equilibrium after all the rounds of experiment. And what you basically see is when the noise is very small, they manage to achieve a very high profit. And when we look under the hood and see what kind of mechanism leads to that, we find evidence that is consistent with the price trigger mechanism. Okay? So they manage, when the market is not too noisy, to coordinate on the price as a device for collusion, trading less aggressively, making higher profits. As noise becomes bigger, this becomes more and more difficult to sustain. And this is because once the market is very noisy, then the price ceases to be a very useful coordination device. And then you see how their profits deteriorate and they do not really manage to collude anymore. Interestingly, at some point, when the noise becomes very large, profits spike up again. And this is where we detect the other type of collusion that is more kind of a stupidity-based collusion, where because of over-pruning and learning bias, they end up achieving higher profits. And we go in the paper into much more detail on how these mechanisms evolve and sort of providing more evidence consistent with those different mechanisms. Okay? So this is the first and the main paper, as I said. And again, the main insight is that these reinforcement learning algorithms essentially learn over time via different mechanisms to behave in a way that is not competitive, that ends up generating higher profits in equilibrium. Let me briefly, I think I have a few more minutes, right? Yeah. So let me briefly talk about the two follow-ups that I mentioned to kind of see where we are going with it next. So the second one, which is also co-authored with Yan Ji in Hong Kong, is basically extending this framework to think about an AI algorithm that is doing more than reactive learning, but is going more into planning. What do I mean by this? So you can think about the kind of AI collusion that I described in the first paper as reactive learning, in the sense that the speculators, the algorithms, were getting information and deciding based on the information how to trade, and they came to some conclusion that it is best for them not to trade aggressively, and this is how they essentially collude. What do I mean by AI planning? Well, this is where AI algorithms can potentially set up a whole course of prices that will benefit them over a few periods, okay? So think about algorithms that are starting to trade in a way that generates a bubble and then a crash. And since they know when the bubble starts and ends, they sort of benefit from the timing of it, okay? So they basically collude to inflate prices and then bring them down and make a profit on the way. This is a more sophisticated version of AI and reinforcement learning. And in this new paper, what we are trying to do is put that in the lab and see how it works and the extent to which it can indeed destabilize the market. So, so I think I basically said that. Let me just show you the main result here. So if you look at the left panel, you basically see how this kind of strategy of inflating prices and then bringing them down works over several periods. So at time 0, they start receiving information about an oncoming shock in fundamental. They coordinate to trade the asset aggressively upwards and then downwards. And on the right panel, you basically see the pattern of price exhibiting a very steep increase and then a sharp decline. So the blue line here is basically the path of the price under this more advanced version of Q-learning. The red line is what you would get in case there was no type of collusion between the AI algorithms. The green line is what you would get just based on the fundamental alone. And basically you can see that here under this version, they kind of think ahead. It's not just reacting to the current news, but it's also thinking we are going to lead to a price increase and then a price decrease. And basically we show through some of these lab experiments that they learn how to do that over time. So in the last couple minutes that I have, I will just say, in the last paper that is co-authored also with Zhigang Li and Lian Yang from Toronto, we basically try to ask, suppose that you have AI and humans together in one framework, what happens and who will benefit more? You can't really do that in an experimental framework because then you will need to bring in humans and tie them to the computer for quite a long time until things converge. So we solved that with a theoretical framework and making some simplifying assumptions about the AI. Our basic take on AI versus human is humans are good at getting new insights. So they will have new signals about the world. But they are not very good at understanding how the market works. So we model humans as having new sources of information, but they are K-level thinking, so they don't understand everything that is going on in equilibrium. On the other hand, the AI is super rational, does reinforcement learning, and understands everything that goes on in equilibrium. So that's kind of the trade-off between the two. And when we model this, and what you see here is basically the gap between the profit that the AI makes and the profit that the human makes. And on the horizontal axis is how noisy is the signal of the humans. And you can see that humans, at the end of the day, end up doing better than AI, both when they have a very precise signal and when they have a very noisy signal. So when they have a very precise signal, they basically have an information advantage over the AI. When they have a very noisy signal, their information advantage is not that useful, but then AI doesn't really learn that much, because remember, the advantage of AI is that it can understand the equilibrium better, but if AI just updates from what humans are doing and humans don't have super useful information, then this advantage kind of goes away. So AI's ability are kind of limited by what humans bring to the table to begin with. And there is only a region in the middle where AI is doing significantly better. So I'll stop here. I think in general, this kind of approach helps us understand what can potentially happen when humans are replaced with AI algorithms employing reinforcement learning mechanisms in financial markets. And we talked about implications for collusion, for market stability, and then also thinking a little more about humans versus AI and what could emerge as a market equilibrium. Thank you.
Thanks, Itay.
All right, it's my great pleasure to be invited to this panel along with these excellent scholars that I admire. Robert asked me to have some fun in this panel discussion. So instead of showing some of my research, which I find boring now, I'm going to try to entertain another thought experiment with the audience. The question I'm going to address is can machines invent the efficient market hypothesis? All right, so I'm not here to legitimate the EMH hypothesis empirically. As far as I know, the debate has not been settled in Chicago yet. So instead, I am trying to use this question to motivate our discussion about the usefulness of GenAI and its limitation. And hopefully, the framework that I'm going to propose can help us organize some of our thoughts about GenAI. And with that, I want to say, I want to give you a disclosure first that the framework I'm going to propose is incredibly simple. There's no math. It's completely heuristic. It does not meant to be rigorous. All right, so let's get started. So I'm going to start with a precise definition about GenAI, all right, in my view, okay? So if you think about, at a high level, right, what is a generative model? Generative model is as simple as a probability distribution from which we can sample data. All right, so we have been using any kind of software to generate a variable from a normal distribution, and that is a generative model. So what distinguishes GenAI is its training medium as well as its scale. All right, so in terms of the scale, right, so the GenAI is using pretty much all the data available to date we have on the internet. And for that purpose, you need a substantially large model to be able to have the capacity to remember such information. In addition, the data are actually human-produced, I would call it symbolic artifacts. All right, and that's why the term AI, GenAI, is very precise, because the term AI was introduced to kind of represent, sophisticated algorithms to mimic human being, right? So, this is very, very good, understanding, or the use of this term is pretty good here. And what's cool here is that human knowledge, right? So it happens to be recorded, or represented in the same, symbolic artifacts, right? So as a result, this GenAI not only can generate some of the data and the text and code, it's actually generating human knowledge, right, in a sense. All right, so, and that is a great deal, right? So, and in addition, I mean, I like to say that this GenAI system is the largest system that we human beings have ever estimated by far. it captures our knowledge accumulated over thousands of years. That being said, right, so here are some important caveats, right? So this GenAI system, they do not reason in the human sense, all right? So they give you some kind of approximate reasoning via pattern completion. In addition, they're not database, right? So they're just like a loosey and structured compression of human knowledge. And they do not know truth, right? So they are just generate output that are statistically plausible, all right? And given the context. All right, so I'm going to take a framework of thinking about GenAI, not as a machine to give you answers, not as a tool, not as a decision maker, but as a prior. All right, so it's a mechanism to provide you with a very rich prior over language, over ideas, over relationship. And this is perhaps the first time in history, right, to have a prior, right, this rich and sophisticated and reusable, right, for finance research, right? So we should be really happy with that. And think about this as a prior. So the model output are essentially, conditioning on the context or generated, so they're random in nature, right? So they're generated, given conditional on the context, right? Conditional on the prompt, and the prior information. All right, and because it's actually a big prior, so and you're using this prior to make inference, so you're essentially, your inference inherently, have the same kind of strengths and bias of the priors. All right, so intuitively, right, using a large language model is like having access of an entire library of experts in your pockets at once. All right, so think about, as a financial economist, think about having, Jim Fama, Lars Hansen, Richard Thaler, right, Doug Diamond, right, 724, right? So you can ask them questions all the time. This is such an elevated Chicago experience that I've never had, but it's something that is in your pockets now. But keep in mind that these experts, right, they may disagree, right? So in other words, you're not going to get something that is 100% correct, right? A prior is not a proof. All right. Now, speak of prior, right? So why priors matter in finance? So I would argue that finance is inherently, is fundamentally in a weak signal environment. Right? Think about measuring, some interesting economic quantities or return predictability or alphas. These are incredibly difficult quantities to measure, right? So how do we, agree with the, risk premium on everything? We would probably not need to do any more studies. And also the identification of economic mechanisms, right? Some of these mechanisms are really ambiguous and hard to distinguish. And also to evaluate counterfactuals. So these are really noisy and imperfect activities. Now, because of that, right? So if you kind of use some research, use some approach that completely based on data, and then the conclusions may be really fragile, right? So that's why we need some ideas to kind of impose regularization, right, or structure, whether they can be, explicit, such as, shrinkage, such as, using some sort of machine learning techniques, or it could be something quite implicit, like a theory, like institutional details, institutional knowledge, or it could be something like a researcher judgment, right? So, but they're kind of more broadly in the form of priors. Okay, so we use priors to regularize a problem. Otherwise, just using data, we'll get conclusions that are generally very fragile. Now, to illustrate the point of weakness in the signals, right? So I'm kind of showing you a histogram of R-squares collected from top finance and top economic journals. All right, now you can see that these R-squares, these are hand-collected R-squares. There are about like 20,000 R-squares we published in the last year, 2022 alone. And as you can see, there is a huge spike near zero. But keep in mind that these are published R-squares, all right? And many of them are in-sample R-squares. Okay, as a result, right, so the real R squares, right, we kind of, deal with are only going to be, more to the left or closer to 0. And I'm kind of trying to use this point to illustrate that the signals we're dealing with are actually weak. There is actually a broader point to make, right? So if you think about, given kind of given what we already know, right, any new findings, right, must be based on relatively, must be trying to find relatively weak signals. Otherwise, somebody else would have already found it, right, given current technology, right? So therefore, I think this point of, weakness, in terms of signal weakness is actually everywhere. It's not just about arbitrageurs alpha. It's everywhere in social science discoveries as well. Anyway, so now that we know priors should help you and, and in particular to deal with these weak signals, so let's talk about how GenAI can help finance research, right? So broadly speaking, GenAI provides you with a prior, and this prior can help you aggregate the information and imposing structure, as I have indicated. Now, in practice, right, so some of the examples the previous panelists have shown you actually fall into these categories, right? So if you think about it, we have been constructing representations, right, so of unstructured information, right? So we've been, turn unstructured data into structured data. That's kind of ways of imposing structure using priors, using large language models. So we have created, for instance, embeddings, right? So news embeddings. We have created sentiment, which is essentially, embedding as well, like one-dimensional, right? So, positive and negative embeddings. We have topics, right, which is another type of embeddings, right? So those are kind of representations that we use our priors from large language model to kind of help us to actually, turn non-structured data into. We can also use large language models to retrieve information, right, to synthesize information, right? So to collect some particular, say risk disclosure in the 10K, 10Q files and things like that. Speaking of embeddings, we also can create firm embeddings, assay embeddings, as the literature have shown you. But in any case, I think, but more broadly, right? More broadly, I think. Financial research involves a lot of exploratory work, such as combining, data, narratives, institutional details, and prior evidence to form hypotheses, to select structures, and to refine economic intuitions. I think GenAIs are generally helpful in all these exercises. But some of these upstream, process of research are, they are central to our design, to identification, to interpretation, but they are kind of not formal enough, right, so far as to kind of cite them or actually, mention them in our study yet. All right, so where am I now? Let me see. All right, so now let's talk about this question, right? Can GenAI come up with an efficient market hypothesis? Well, let's start with some simpler ones, right? So could AI discover return predictability? I think a lot of research have shown positive evidence that AIs can find alphas and can find high Sharpe ratios, including some of my own. So I would say extremely well. Could AI document anomalies? Right, I think, a paper by Novy-Marx and Velikov, they have actually tried to generate anomalies at scale, and their exercise was very interesting and quite successful, right? So I'd say yes, all right? But could AI independently invent EMH as an equilibrium concept about information, competition, and price formation without being told to think in those terms? So in other words, had Gene Pharma had that GenAI tool in 1970s, well, not Gene Pharma, I guess, but had somebody have that tool in the 1970s, would they be able to, propose efficient market hypothesis? I think under the current paradigm of GenAI, I think it's very unlikely. At a deeper level, I think EMH is not just a pattern about predictability. It's about reframing. It's about framing. It's about conceptualizing this price as equilibrium outcome. And these are things that are new, and they're not in the data of AI training, and they're not particularly square well with the objective function of GenAI, which I'm going to talk more about right now. Right. So why this is hard for GenAI? I think this has something to do with the training algorithm and also the availability of data. Let's start with another analogy. If you're not like the EMH example, let's talk about general relativity. Right, so I would also think that general relativity is not something that GenAI can come up with independently, because in that theory, it's not like based on experimental data, right? So in fact, data only come later, experiment only come later after the theory has been proposed to verify it, and the theory essentially says that gravity is actually redefined as a space-time curvature, right, instead of a force. That's a brand new idea, and based on invariance principles and new primitives, I don't think GenAI is trained to do that. Another distinction holds in mathematics, as Xavier mentioned earlier. So lots of GenAI companies are trying to sell their great benchmarks in terms of Olympiad math, right? But Olympiad math is essentially a closed system with theorems that are right, and you can try different ways to prove it, but they're right, right? So the lemmas the number of lemmas, theorems are finite. But research mathematics is completely open territory, right? So you don't know whether a conjecture is true or not. So in this situation, it's hard for GenAI at this stage to actually compete at the human level. To summarize, right? So I think if the patterns in the data are really weak, or you don't have enough data, then GenAI would suffer. If the objective or the reward reward or loss function in a reinforcement learning environment are ambiguous, and then AI would be it would be difficult for AI to actually help. The last part I can also think of is, for instance, in the reinforcement learning scenario, right? So you have to pre-specify the action space, the state space, right? So in other words, if the true solution, if the truth lies outside the space that are predefined, that would be a completely uncharted territories for AI, for reinforcement learning algorithms. And that would not be possible for reinforcement learning algorithms to actually find out those solutions. So uncharted territories are things that I think the current algorithms would not be able to actually deal with. All right. So given that I have actually set up this framework, let's also think about what else we can learn from it, right? So, as I already mentioned, each generated output can be regarded as a draw from a, learned prior. So the prior is learned from the data, right? So it's a big GenAI model over some latent representations like embeddings obtained on the, and conditioning on the prompt. So this is how I understand the output from a GenAI. And hallucination now becomes pretty easy to understand, right? So hallucination arises because it's essentially give you something that is statistically plausible, but is not necessarily true in a given context. All right. So and the learned priors will also inevitably inherit biases presented in the historical data we human being generated, right? So in other words, AI trained with human data will mimic humans. That's not, that's going to happen. And also, confidence, right, so reflects this within frame certainty. So in other words, if your prior is heavily concentrated on the continuation, and then, the generated, sentences will be, looks like really confident. So this is like, this is why sometimes when we see AI hallucinate, it looks like pretty affirmative, but that confidence is actually because the prior is heavily concentrated around this continuation. Now, on the other side, sensitivity to prompts is kind of really about the fact that your prompt moved a little bit to different. Your prompt moved the prior to a slightly different region, and as a result, the generated response may be quite sensitive to that. But in any case, I think priors would be able to aggregate information as well, but they're not able to revise objectives. They're not able to discover new structure. All right. Now, speaking of, if you think about priors more seriously, and then, it leads to the following question, which, I'm not sure if this is a good topic to discuss here, but so it's about research norms, right? So turns out GenAI has already been adopted, right, in the research process, including upstream exploration, as I already discussed, as well as reviewing. All right, so in fact, according to a recent Science and Nature articles and news articles and also research articles, we find the majority of, not necessarily majority, but lots of researchers have been using GenAI tools, not only for writing papers, but also for reviewing papers, all right? So, and on the other hand, many researchers feel you might call it AI shame or uneasy, acknowledging the fact that we're using AI, particularly when it occurs upstream of formal analysis. So my view is that I think this is more like a reflection of the mismatch between existing academic norms and how research is actually conducted when externalized priors become available, right? So as we have said, we now have externalized the priors, and typically researchers are, using priors in their own mind, right? But now you have externalized the priors, you're using it, you have to acknowledge it, so it's a hard question. But in any case, I'm going to follow the norm, the existing norm here, and disclose that the slides were prepared with the help of GenAI. But my own judgment still matters here. I decided which things that I'd like to include in my slides, so all errors are mine. All right. So now let me talk about some implications for financial economists. All right. So I think this externalized prior is really providing us with a golden opportunity that kind of help us level the playing field. And raising the baseline productivity across the profession, right? So a lot of things that now, we can do it easily, such as data analysis, such as polishing or writing, things like that. So which means that, the comparative advantage is going to be shifted away from routine implementation. All right, so in addition, these new AI tools also provide us with interesting new things we can study, new topics we can study. We can study human AI interactions. We can model, human beliefs better and things like that. We can conduct surveys, But as I have mentioned, I think now the bar for novelty, for original ideas, probably also rise. We really are looking for ideas that can complement AI, right? By shaping or challenging or reinterpreting the priors implicit in the AI output. And I would suggest economists to use AI actively, not be ashamed of it, using it, but cautiously, because you not only have to you're still the decision maker, right? You still have to judge whether, whether you agree or disagree with the output. Your internal prior still matters. But nowadays, you also have to kind of, be responsible for the output that you decide to include, right? Because you have to oversight, you have to, carefully oversight the AI output, the generated AI output. Now, I could end my talk here, but, I cannot resist the idea of the next question. So why we have a panel of humans given that you all have a prior, right? You have the prior of, you have experts, you have a vast library of experts of all kinds, and you can ask better questions, right, than the questions that you're going to ask us. So I think maybe part of the answer is, you want to see some kind of judgment formed in real time. You want to see us disagree with each other. You might want to see some, embarrassment. But I think, the human touch is still matters a lot, in particular when the objectives are ambiguous and the research questions are being formed. Well, to end my talk, I'm going to show you what I did with the ChatGPT. So I'm kind of asking ChatGPT to actually guess what other panelists might be thinking about. Right, so my panelists are all their priors are already in ChatGPT, so I think ChatGPT can do a pretty good job, knowing what they're doing. And these are actually generated scripts in the spirit of GenAI. Why don't we create some digital avatars and have them actually, can you play the video, please? Have them actually discuss.
Provocative question, GenAI summarizes papers, writes code, and drafts referee reports. Productivity shock or redefining what a finance scholar is?
I think it's a productivity shock, but not because AI replaces researchers. GenAI collapses fixed costs, data cleaning, boilerplate code, and spec testing that used to take weeks. That shifts the constraint. Execution isn't scarce anymore. Problem formulation and judgment are. In finance research, GenAI raises the return to taste.
I broadly agree, with the caveat productivity shocks aren't neutral. When you slash the cost of producing results, you flood the field with results. Then selection becomes the challenge if everyone runs 10,000 specs. Which ones matter? Theory structural thinking must discipline the search, or we drown in correlations.
Let me come at it differently. In finance, we study how information shapes behavior and stability. GenAI changes the information environment itself. Everyone gets instant interpretation and narratives. It may amplify herding, overreaction, and coordination failures. So GenAI isn't just a tool, it's an object of study. Models should treat agents as delegating cognition.
All right. So I think the AI did not quite get everyone's accent, but with that, let's have the real panel started.
All right. So I'm going to ask a few questions first, and then we can open it up to the audience. I think for this, if we can answer kind of in the reverse order we presented, so that you can come to me last, and I can tell the people if they were right or not. But I was going to start with some big questions, but kind of with how Dacheng ended things, I guess I want to start with a littler question, which bothers me a lot, which is, should we be citing AI, and will we be citing AI in a few years?
All right. So, I think this is a good question. That's why I kind of started this in my slides. As you can see from my view, I think priors are something that I really think of AI just like externalize the prior. And when you use a prior in the upstream analysis, exploratory analysis, and before a formal paper is written, it's hard to tell whether whether it should be given the credit. So that's why I would be more cautious about giving credit to ChatGPT or some other GenAI text.
Yeah, I would say generally probably not. I think AI is an input that goes into research and not a collaborator on research, so I would tend not to cite it.
Well, I think we should, of course, cite AI. Let's take a limiting thought experiment. Suppose you have an AI who finds a new big proof of something, say Riemann hypothesis, something. Of course, it should be cited. Now, of course, maybe that will be in 50 years. Maybe in the meantime, it will just be some lab that will have a very, very good software, and they will acknowledge the input of ChatGPT in their special software that they want fact that at some point, if machines can produce essentially the whole thing by themselves, it will be the machine maybe helped by, a few humans in the background. Yeah, they should be cited.
So my view is maybe in 50 years it will be writing the proofs and citing itself, but until then, it's a tool, and you have to take responsibility for the output. And I just think it's crazy that we, are asked or required to cite a tool that we use in research production, because ultimately the work is yours, and if you're good at using a tool, that's part of your research production. But I don't make any of my students cite AI, and I don't think we will be doing it in the near future. So is it just a tool? I mean, economics was done very differently before kind of connectivity and machine-readable data. Before that, it was done differently before we could run regressions easily and had computers. This is a new tool, but is it different, or is it qualitatively different, or is it just another tool that's going to change things a bit? This is, I guess, a reframing of Xavier's question as he was going to survey people on whether we were going to be obsolete in 5 years or 10 years.
Oh, okay. So it's a question about human and AI. So I think, in my view, human will not be obsolete for the following reasons, right? I mean, imagine. I mean, there are several reasons. So first of all, I think about the case where, it's completely AI, and then AI would have to train based on their own data, right? So the data generated by AI and they train on that. And we know that training AI on this generated data is going to degrade the performance for obvious reasons, because the generated data, they're not going to, perfectly reflect information on the tail, right? So as a result, the trained data will see, the trained machine will see more and more data in the body, the main body part of the distribution, and eventually the performance will keep degrading and eventually to a singularity. So I think human and AI in general will coexist harmoniously in a system where human can provide data, at least. Now, in addition, I also think the training algorithm, at least the current training paradigms, cannot handle situations like what I discussed. For instance, the objective is ambiguous or is on completely uncharted areas. So I think humans are still there to propose, what are the good questions, what to write in a prompt, and things like that. So I think we will coexist.
And is it similarly important or qualitatively different than the other big steps we've seen in the last decades?
Me again? Okay.
Yeah, just.
I mean, I don't know. I think, I feel like they're equally important issues, right? So providing data, come up with good questions, come up with the evaluation criteria, things like that. I think they're important issues. As important as training an algorithm, training an algorithm. Yeah.
At this point, I think it's a tool, and when I try to think about how things will evolve in the future, I tend to believe, just like Dacheng, that humans are not going to be obsolete. I think there are particular skills, particular angles that humans will bring to the process that will be hard to replace. And one, of course, is creativity, originality, coming up with new ideas, new frameworks, as we heard before. There's also the human interaction. I think Xavier mentioned teaching. At the end of the day, I think a lot of what we do does boil down to human interaction, and those things will be difficult to replace. Is this a substantially different types of innovation, or is it just another innovation? It's certainly very significant. I think that's hard to deny. But I don't know that it is entirely a new class. Because when you think about some of the things that we experience, the way that data sets have been evolving, the way that the internet came up, I mean, all these things have changed the process of research quite a lot. And I think AI may change it more, but I wouldn't put it completely on a class of its own at this point.
Well, I mean, in the short run, of course, they're just a tool, but in the long run, in the medium run, the long run is too far. It's not clear. I mean, again, if AI can do not just Olympiad math, but really top level research math, then mathematicians are largely obsolete, except maybe as intermediaries to explain to the broad public. If AIs can make write jokes funnier than any humans, then also we're kind of useless. If they write music more enchanting, and also we're kind of useless. If they write novels and movies that are much better, movies they are pretty poor. What are humans good for? When is that moment? Is it in? So of course we can't do it now, but given the trend on the log axis is going fast, so I don't know, maybe in 10 years or 20 years, definitely, I think we'll be obsolete. I don't know, probably 90%. I don't know, it's a bit out of nowhere. I'm good for you if you already have tenure. I'm a bit worried about the balance sheet. The balance sheets of universities giving tenure to newly minted people who should be there for 40 years. I don't know what those people will be useful for. But anyway, including us, by the way.
I have no idea. I don't think anyone does, but I will take the over on Xavier's timing of that. So, good or bad for experts?
Good, bad for what?
Experts.
Experts. I also kind of briefly mentioned this. I think it's going to level the playing field for many, right? So, experts who were, if their expertise was to propose, new economic theory, new ideas, new frame, I think that kind of expertise will still be valued. But if their experts is like writing, codes, clean data, I think that kind of expertise will depreciate in the near future.
Yeah, going back to what I said before, if this is a task that cannot be easily performed by human, then it's good for experts. So if you're an expert that comes up with original ideas, then AI helps you. If you're an expert that relies on human interaction, I think AI can help you. But if you always sit in the back office and just prepare PowerPoint presentations, maybe that's not so good for you.
I think there's a bit of empirical evidence on that, on just what happens in law firms, etc., that people who already have a tenure or partner in the law firms, they do well, and at the entrance, level people, the equilibrium pay has been going down. So maybe for a short while, the experts, do have their comparative advantage, and it's eroded more at the level of entrance. In the long run, if you want to be an expert in finance, I don't know what, or in any field, again, fundamentally, there's nothing that makes the AI not surpass humans at some point. Yeah.
So I think mine was a trick question. I think the answer is yes. So I think it's, well, I mean, I have no idea about this
Good
either.
or bad?
But
Yes, which one?
yes. To
Yes.
both.
Oh.
So I think, for the true outlier experts, the very best in the field, they're very valuable. AI is very valuable for them. That there are ultimately people who need to judge the output of the model and understand how they work. But I think for, people who have expertise, but not the same degree of expertise. We need fewer experts, but the experts we need. I think in some ways it makes the value of being the true experts in any field higher, and being very inframarginal much lower.
I mean, then you get into alignment and those things. So here we were all imagining benevolent, truth-oriented AIs. Of course, then if they want to, game humans and take over or whatever, then we need human experts to somehow act as a buffer. There will be some interesting principal agent.
Also, again, they are mimicking, so they're not always right, and it's hard to judge often if they're right or not. And fewer people can do that than are experts in general. will the impact on what we do in social sciences be different than in other fields of academia or science? Are we somehow different?
I mean, I don't see much difference between what we do and what they do, except that our stuff probably more subjective to some degree, and which means that we need more human judgment, and then somebody who just kind of prove things and do experiments and discover something that nature precisely pre-specified. So I would think for us it's actually our judgment matters even more. Yeah.
I mean, I think we are probably right in the middle among other disciplines in terms of how subjective it is and how much human judgment you need. So that would also be the extent of impact that we will have.
I would say humans will remain more important. So human researchers remain more important in the social sciences than in, say, in math or physics. Why do I say that? Because in math, just on fundamental grounds, math and physics, you just need the internal logic of things, and you can train on proposition, you can verify them, etc., without any almost human impact. Physics is more complicated because at some point you need to test in the real world, and there's an issue of having robots who would test the materials or things like that. Whereas say biology is going to move very likely much more slowly because you can imagine lots of the molecules, but at some point the reason why developing a drug costs $2 billion because you need to bring 2,000 people and test their blood and their pressure, etc. every month, and you need nice nurses to make them walk through the hospital. So it's very, very human intensive. And so we in the social sciences, we're kind of in between physics of material physics and those very, very costly medical experiments where you need to deal with lots of humans. So in that sense, interfacing with humans is more important. So it will force AIs to conquer us much more slowly.
So I think we're different in that we don't have a ground truth to train the models to. I mean, we're training the models to sort of collective wisdom, but these AIs work best and are easiest to train when there's a right and wrong answer that with certainty is right and wrong. And we can't do that kind of training, so I think it makes it much harder. I'm happy to open it up to the floor, too. People want to get involved here? No one wants to go to a speaker?
Okay, I'd like to ask a question, vote. So it's I wish I had thought a little more about the question, make it more actionable, but the aspiration for the question is, in how many years will we be obsolete? So I'd like to say, so what fraction of the room, and I wish somebody could have a phone to just to try to ask the AI to quantify the fraction of the room, but who thinks it will be obsolete within the next 25 years? Okay, in the next 10 years? Okay, that's interesting. Very good. In the next 100 years, again for research kind of thing.
100 years?
100 years, yeah.
It's hard to tell.
Okay, so it's not a full distribution. Who abstains? Maybe it's the wisest position.
What about Neville?
No, I agree. There's an issue of what obsolete means, exactly. Here I couch it on the labor share. It could be some sort of labor share of research papers, but an issue of publication bias, so I'll think more about the question, make it operational. But here my reading is that for the 25 years, there was maybe a third of the room who said it will be obsolete within 25 years.
So let me ask you a follow-up question. Yeah. So you say obsolete, meaning that AI is going to write all the research. My question to you is, who is going to read that research?
Oh, no, it's not about, it will be understanding, so it will be useful to, predict.
I mean, you're saying there will be no humans working as professors.
No, will be, the same way, you as informed citizen, you would say, oh, what created the cosmos? Oh, it's kind of interesting, and you hear a bit about the Big Bang, etc. You don't need to know all the fundamental physics equations and inflation theory and all that, but you hear the little story. So likewise, with this great understanding over there, and we'll hear the little stories for children or curious teenagers, and that will be very satisfying,
So do you know that like 5 years ago, Geoffrey Hinton has this famous, statement saying radiologists are going to be obsolete in 5 years.
Right.
Right. What happened is, we have more of them.
Exactly.
Right?
He should have
Some
thought,
tasks are,
because it's the
right,
complementarity. He should have thought the complementarity with the AI making photos and the radiologist is less than one. So they're complement rather than substitutes. If he had learned a bit of economics, he wouldn't have made that gross mistake. Yes.
Okay.
So given Xavier's pessimistic view about tenure in the future, and the bimodal distribution that this conference tends to attract of people who don't care because they have tenure, and those who still are relatively young and need to get it, I guess is there...
I can add something to this issue.
Okay,
right?
yeah, so let me finish with the question, and then you can take it a different way if you want. But I'm just looking for something more constructive, because there is this notion that technology doesn't replace jobs, it replaces functions, and some jobs have more or less functions that get replaced, and the jobs that don't get replaced, you end up doing something different than what you used to do. I guess the question is, in a world in which AI can do a lot and replace a lot of functionality of our jobs, what aspects of our jobs are most important to develop and concentrate on so that you're rewarded in the future for doing the job you do? So what advice would you be giving to young researchers who don't yet have tenure on what they should be concentrating on and what aspects of their jobs they should be sort of promoting and emphasizing to be successful?
Right. So I was about to kind of mention something about like tenure and other stuff. It's kind of related to what I said in the slides about AI anxiety, right? So given that AI has reached the bar for writing papers, and given that many people in this room have their productivity increased by using Gen AI techniques, so I would expect more papers to be written, the bar is going to be higher, and many people in the room might also, like me, worrying about left behind. These are things that keep me up in the night. So I think AI anxiety is a serious issue. Now, to battle that, I'm not an expert to do that, but I do think, when I think about how to train my 9-year-old, I would still think, analytical skills, mathematics are kind of important things that are hard to be, replaceable by an AI. And if you want to invent new AI algorithms, you would have to understand what's going on. On the other hand, if the skills are something like just labor-intensive things and it's going to be replaced by AI clearly, and you should probably try to focus on more, to change your jobs or whatever. And also, like jobs are related to sentiment, human sentiment, human touch. I think going to be safe for now. Yeah, things like that. Yeah.
I mean, in some sense, I think the advice I would give an assistant professor today is not that different from the advice I gave 20 years ago. I mean, 20 years ago, I was still an assistant professor myself. But I think the advice is fairly similar, which is to think about big ideas, to try to come up with a new research agenda, new model, new framework, whatever you do. But basically, we call it a home run. Think about big ideas, big papers, and try to develop them. And that was always true. Maybe now in the era of AI, it's even more true because those things are more difficult to replicate with AI.
Yeah, what I tell the students, or what it's worth, is, of course, learn lots of AI. I mean, a lot of, I'm surprised they're not that the fraction of job market papers using intensely AI themes is not higher. I think it will be higher, it should be higher. For instance, like the trilogy by Simon Ho I mentioned earlier with creating new data, finding new techniques to massage existing data, etc. And for more theory-oriented people, more in general, if you remember that Kakutani matrix, try to think about a few things that are simple and hard. So what's complicated and will be just too quickly, but easy using existing well-known things, will be too easily replaced by AI quite fast. Whereas maybe there's room for this kind of think about a few difficult things, try to trace a research agenda. When you try to give that as an assignment to the PhD students, try to delineate your research agenda for the next 10 years. They said it was extraordinarily anxiety-producing, and they didn't like it that much. But some did. I think it's a very good exercise, actually. Just try to think. Try to create some big picture, and every 6 months, try to, even as a grad student, try to find what are the great questions you would like to answer and that still are answerable by some conceivable tools. This kind of meta thinking, a lot of what we reward is, being clever. You can solve math problems, given problems, homework problem very fast. But the more meta-cognitive level, which is what will I do with my finite cognitive and time resources in the next 5 years? Siri wants to intervene. No. We don't develop it enough, and so maybe there's a way to try to develop that in grad school or personally.
I agree with everything that was said. I also think that, I can envision a world where the things that are already important and underinvested on by a lot of our profession become even more important, which is just the interpersonal aspects of it are already so important in everything we do. And I think selling work and paying attention to the theatrical aspect of presenting and doing a good job on that aspect. I'm not saying that should be what wins in the war of ideas, but I can imagine a world where that becomes more important because getting attention and having people care about what you're doing gets harder, and doing a good job on that aspect becomes more important.
But so I should have said something else. So something else which I mentioned in the little talk is just more engineering applications. You have all those new tools. So before we say, oh, it's too sad because there won't be there will be less room for beautiful purely academic papers, but certainly there should be lots of great engineering applications, and really need that. Finance has been very, very useful via maybe portfolio formation, a la Markowitz and fancier things, Black-Scholes, but a lot of the more recent theories, I'm sorry to say, have not been that useful. And with this AI, then you can think you can be productive members of society, also become extremely wealthy, and donate to those universities that may be ruined by their business model later. So I think that would be a very productive thing. As a PhD student, do something that's based on AI, but somehow can help the world, make the world better as a concrete engineering tool. It could be predictions, it could be advice, it could be somehow automatized production of discovery or something. I think that would be those would be a great contribution of our social sciences. Otherwise, we look a bit strange doing our internal game that doesn't seem to interest a lot of people, except hedge funds who want alphas.
So there is one issue that I was worried about when we think about having a competition for say predicting returns and things like that, right? So we know that we don't have a lot of data, and we have seen our algorithms have been trained by essentially all the data up to now, right? So to really truly evaluate the performance of a new machine, we need to wait for a long time.
No, that's why the stuff with Ralph, Moto, and Rob. We're very careful. The type of things I mentioned, it works with one cross-section. So now it's a limited amount of prediction. You say, given given, I tell you lots of things about what happened in 80% of the stocks in that quarter, try to predict, in some sense, what will happen, what happened in the same quarter in the remaining 20% of the stocks. Okay, but then to be able to do that, so it doesn't predict returns, but it means you need to understand well enough, even retrospectively, what happened to those 80% of the stocks, to then guess, if you want, what did happen in the same period to the same 20%. So this is a world in your slides where you have a pretty high R-square, okay? So we are embedding the order of magnitude 50%, and there are lots of room for improvement at the same time, okay? And then that will be some form of understanding. The same way if you for a variety of image recognition, etc. If you recognize the image, it forces you to do some form of understanding. Likewise, if you can understand 80% of the market, knowing 80% of the market, you can predict what happened in the same quarter, remaining 20%. It means you have some quasi-structure, some modeling of forces in the economy, etc. I think that will be a measurable progress, for instance.
Right. So another kind of tiny kind of point that I want to add to that is, I think return prediction is an interesting exercise. No wonder I'm trying to do it. Partially because you can evaluate the economic, you can evaluate your prediction in economic terms, right? So I think your slides you also mentioned about predicting macros, right? Predicting other stuff. I think that kind of literature can stop at reporting MSEs. Which is kind of hard for me to really appreciate the improvement in the MSEs. So I wonder, if this could be an issue for certain prediction exercises.
No, so I think one productive activity is developing interesting benchmarks.
New criteria
that are not too time series dependent, because any new quarter of macro or financial data doesn't give you that much. I understand that so Helum, Brian Kelly, Thijs Jensen, and Lasse Pedersen, they're developing some competition, and we're in some email conversation to add our cross-sectional benchmarks, and maybe that will be useful. Again, it's not that we care directly about the outcome, but it just forces some creating machines that de facto will develop some understanding of the situation, I think.
So I asked about advice you'd have for junior faculty. What about for journals and P&T committees?
For what?
Journals and P&T committees.
P&T committees?
Well, I think that the way that we can write papers now and the tools are going to swamp journals, and it's going to make citations, at least the way they're currently measured, much less informative. And
right. I think in terms of Google Scholar citations, for instance, right, or SSR downloads for the similar, I think that's certainly something that we should now think about or truly focus on. And if we, in Chicago we can anywhere else, right? I think we evaluate papers' impact, not necessarily by these measures. These measures are easily, influenced by Gen AI tools, as you correctly mentioned. I totally agree with you on that. Yeah.
And journals?
Journals. So far, I'm the editor for one journal and associated for a couple of journals. I do see sometimes that we have articles that looks like generated. For that, I would always just desk reject, not wasting our resources. So I think whenever new technology arises, there are bad actors expected, right? So if our system have not built up a good defense system, we probably have to do things more aggressively, and So I do kind of desk reject a lot of papers.
Yeah. So I think I stepped down from my editorial position just in time, because it wasn't an issue when I was still an editor, or at least it was just starting to be an issue. But it is certainly a problem if people are going to abuse the system and start generating papers with AI and not much human involvement. And journals got to have some system to detect that and obviously desk reject it. So I think it shouldn't be acceptable that someone does that, and it should be desk rejected, and there should potentially maybe even be a penalty associated with that. I don't know as much as you probably how easy it is to detect when it's completely generated by AI. But assuming that you can fairly easily detect that, I think journals should clearly protect themselves against that. Regarding your question about citations and promotions, I mean, I agree with the view that we always think about citations as just one indicator. I think in general you are looking to assess what is the overall quality and impact of research, and we look at how many papers people write, we look at where they publish them, we look at how many times they are cited. But we also look at other things, like how they are evaluated by peers and people in the committee themselves. They are expected to read and have some evaluation of the paper, thinking about potential impact, if impact is still not there, thinking whether the impact that you see right now, maybe it's just artificial, maybe it's not actual meaningful impact. So I think we should continue to just treat that as one signal. I don't know that it's necessarily becoming less important than it was in the past, but as long as it's not taking over the whole evaluation system, I think it's okay.
I think, Robert, you were saying there will be many more papers, so how does a finite editorial capacity can handle all that? So, I mean, perhaps the whole journal system we have should die, and it's just a bit crazy, and it should become, as it is now, all this time we spend in revising into the, putting the paper from perfection 95% to 98 to 99 to 99.999. I think it's a huge waste of time in the broad scheme of things. And maybe we should become more like math and physics, where you have a little bit of a hierarchy of journal, but not really. And people say, actually, when I talk to some friends who are in math and physics, they say, look, translate a bit of their language, we let the market decide. So it doesn't matter where the paper is published. We can see a bit later if it's taken off well or not. And in fact, it's kind of endogenous. Given the publication lags are much faster, it's much actually easier to see if the idea takes on or not. So we have a much more blurry tools vision in economics, because often it takes 5 to 10 years to publish a paper. So maybe it will be, sorry, it's likely it's going to be completely, this abundance of new papers will be totally unmanageable by existing number of journals, and the system will crack, and that will be for the better, and we will have all this obsession with the top 3s and top 5s and all that.
We had an audience question there.
Suggestion is creating a competition to create an AI. Going with your suggestion and Brian Kelly's work, suggesting a competition where we have a journal that uses AI to test the papers if they are created by AI. If not, comes through.
Yeah, that sounds like a very good idea. It could be. It doesn't need to be a journal. It could be a much more automatic, web page, quote unquote, service. Yeah.
And using your terminology of being obsolete, if AI creates a paper and AI accepts it, then we don't need us. I don't think that will happen, but.
Yeah.
Just a great comment. You asked a question, you mentioned about experts and where will they be. So I just wanted to share a thought on that. So I think experts certainly will become more effective. There's no question about it, and the gap between the experts and the others will widen. And the other part, Itay, you were talking about it earlier today, of why do we, looking at the blockchain issue and the DeFi, what are better outcomes, right? So in a corporate setting, where they're making capital allocations, right? The risk in decision making is lowered when you can do red team, blue team discussions, and AI is extremely good at giving you different points of view so that the human being can then choose which way to go. And in an international setting, US businesses are known to be more competitive. Executives make decisions with 60% information as opposed to Germans who need 110% certainty before they make decisions, capital allocation and business decisions. In that setting, in the international setting, it will level the playing field more and make other countries more competitive than the US, because it'll give greater certainty to their decisions, and they can make capital allocation decisions and board level decisions earlier at a lower level of involvement. At least that's, so I'd like to know if you have any thoughts on that.
So maybe I'll just add one more point here to clarify one thing, right? So I don't know whether it's relevant to your question or not, but I think in certain settings, human experience matters quite a lot. And Gen AIs, at least the current system, are not trained to actually, to actually put. So the current Gen AI systems are trained by statistical associations, right? But if you think about human experience, sometimes you care something more because of your utility loss, not because of certain things happens more. So I think in a general decision-making scenario, human experience are quite important, and the current Gen AI systems are insufficient to actually handle very general settings, and we would need new training algorithms or machines designed specifically for a setting to deal with those things.
All right, well, we're out of time, but thank you very much for coming out. And I, at least for one, will stick around and talk to anyone who wants to talk longer. So thank you, guys.